Have you ever looked at a stock chart and wondered, what on earth am I looking at? There are green candles, red candles, lines crossing everywhere, and somehow people on the internet seem to know exactly what's going to happen next. Some are shouting buy, others are screaming sell, and if you're a beginner, it can feel like everyone understands a secret language except you. The truth is, they aren't reading the future. They're reading the market. And just like learning any new language, once you understand the basics, those confusing charts begin to tell a story. That's exactly what technical analysis is all about. Let's zoom in on just one candle. At first glance, it looks like nothing more than a green or red rectangle. But that tiny candle represents thousands, sometimes even millions, of decisions. Someone bought because they believed the price would rise. Someone sold because they were afraid it would fall. Some investors were excited, others were nervous. Some were booking profits, while others were entering for the very first time. Every candle is simply the result of people making decisions with their money. Technical analysis is the study of those decisions, reflected through one thing: price. Now, you might be wondering, but don't investors study companies? Absolutely. That's called fundamental analysis. A fundamental investor wants to know whether a company is actually worth investing in. They'll study revenue, profits, debt, management, products, competition, and dozens of financial reports before making a decision. Technical analysis takes a completely different approach. Instead of asking, is this a good company? It asks, what is the market doing right now? Because regardless of what you or I think about a company, the only thing that actually moves the chart is people buying and selling. And that's exactly what we're studying. Imagine you wake up tomorrow morning and see the headline, Company XYZ reports record profits. Almost immediately, people begin buying the stock. As more buyers enter the market, demand increases, and naturally, the price starts moving higher. Now imagine the opposite. Bad news breaks. Investors panic. Selling begins. Price falls. Notice something interesting? Whether the news is good or bad, it eventually shows up in only one place: the chart. This is why technical traders spend less time reacting to headlines and more time watching how price responds, because the market always leaves clues. This brings us to one of the most important ideas in technical analysis. The market discounts everything. At first, that sounds confusing, but it's actually very simple. Think about everything that could affect a stock: company earnings, interest rates, government policies, global events, investor emotions, institutional buying, retail panic. All of these influence buying and selling decisions, and buying and selling create price. So instead of trying to analyze every single event separately, technical traders simply observe the final result, the price itself. Because price already reflects everything the market currently knows and believes. Now, let's move on to the second principle. Markets rarely move in a perfectly straight line, but they do have a tendency to move in trends. Think about climbing a staircase. You take a few steps up, pause for a moment, then continue climbing. That's exactly how an uptrend works. Price moves higher, it pulls back, then continues higher again. The opposite happens during a downtrend. Price falls, recovers slightly, then continues falling. Of course, trends don't last forever, but statistically speaking, once a trend has been established, it's more likely to continue than suddenly reverse. That's why successful traders prefer trading with the trend instead of constantly trying to predict turning points. Now, here's something fascinating. The markets today are filled with computers, smartphones, artificial intelligence, and lightning-fast trading systems. 100 years ago, none of those things existed. Yet, if you compare stock charts from then and now, you'll notice something surprising. The patterns look remarkably similar. Why? Because technology changes, companies change, economies change, but people don't. Fear, greed, hope, regret. Those emotions have remained exactly the same for centuries. And since markets are driven by people, human behavior keeps repeating itself. That's why chart patterns continue appearing over and over again. Let's understand this with an example. Imagine a stock has been trying to cross the $100 level for weeks. Every time it reaches that price, sellers push it back down. Eventually, buyers become strong enough to break above $100. The breakout finally happens. Now, think about the people watching this. Some regret not buying. Some sold too early. Others even bet against the stock and are now stuck in losing positions. A few days later, the price comes back to $100. Suddenly, everyone who missed the breakout sees another opportunity to buy. The traders who were trapped also rush to buy back their positions. That fresh demand pushes the price upward once again. And just like that, yesterday's resistance becomes today's support. Not because of magic, because of psychology.
One mistake almost every beginner makes is trying to predict the future. This has to be the top. It can't possibly go any higher. Or, this stock has fallen too much. It has to bounce now. The problem is, the market doesn't care what we think. Professional traders don't try to predict, they react. They wait for confirmation. They let the market reveal its direction first. Only then do they make a decision. That small change in mindset makes an enormous difference. As beginners, it's tempting to believe there's one magical indicator that never fails. So people keep adding indicators. RSI, MACD, Bollinger Bands, Stochastic, ADX, Ichimoku. Before long, the chart becomes so crowded that every indicator says something different. Instead of gaining clarity, they create confusion. The truth is, no indicator can predict the future with 100% accuracy. Successful trading isn't about finding a perfect tool. It's about having a strategy with a small statistical edge and managing your risk consistently. One of the biggest lessons you'll learn in technical analysis is that simple usually beats complicated. Focus on price. Use volume to understand conviction, respect trends, manage your risk. That's enough to build a solid foundation. You don't need dozens of indicators. You need a clear process that you can follow over and over again. Technical analysis isn't a crystal ball. It won't tell you exactly what the market will do tomorrow. What it does give you is something much more valuable. A framework for making better decisions. It helps you understand market psychology, recognize trends, identify high probability opportunities, and manage risk with confidence. Over the next few lessons, we're going to build this knowledge step by step. By the end of this journey, you won't just be looking at charts. You'll actually understand what they're trying to tell you. So, let's get started.